Common Investment Meeting for March 20th, 2017, rescheduled because of the snowstorm last week. Let me just review the schedule. No, let's do the roll call and then we'll do the schedule. Okay, so folks are in different positions today. Let's therefore change the order. Let's start with the fire fund. Steve?
Yeah, roll call of trustees, Mr. John Adler.
Yes, I'm here.
Susanna Vickers.
Here.
Antonio Rodriguez.
For Antonio Rodriguez, designee for Commissioner Jock Jiha.
Mr. James Slevin.
Eddie Brown, for James Slevin's proxy.
Mr. Gerard Fitzgerald.
Present.
Mr. Eddie Brown.
Present.
Mr. John Kelly.
Gerard Fitzgerald for John Kelly's proxy.
Mr. Jack Kelty.
John Farina has Jack Kelty's proxy.
Mr. John Farina.
Here.
Mr. Paul Farrow.
He's here.
He is here. He must have just walked away to get a cup of coffee. And Mr. Thomas Phelan.
Here.
Commissioner Doug White.
Here.
That's fine. We have quorum. Yep.
Okay, thank you, Steve. Let's move to the Police Pension Fund. Kevin?
Good morning. Representing the PBA.
Joe Alejandro.
Joe Alejandro, designee for Patrick Lynch, John Puglisi, Mubarak Abdul-Jabbar, and I have the proxy for Corey Grable.
DEA. I know Mike's here. Okay. SBA. LBA.
Lou Turco, LBA.
CEA.
Lou Turco has the proxy for Roy Richter.
Commissioner of Finance.
Phil Dukes, designee for Commissioner Jock Jiha.
Mayor's Office.
John Adler, designee for Mayor Bill de Blasio.
Comptroller.
John Dorsa for Comptroller Scott Stringer.
And the Police Commissioner.
Rosemary DeBellis, designee for Police Commissioner O'Neill.
We have a quorum.
Great, thank you. Next, teachers. Patricia?
Yes. John Adler?
Yep, here.
Thomas Brown?
Here.
David Kazansky?
Here.
Deborah Penny? Charlotte Beyer? Susanna Vickers?
Here.
We do have a quorum.
Great, thank you. And NICERS. Yes, still here.
Here.
Present.
Here.
Here. Here.
Great, thank you, Karen. Okay, Burrs, sorry. Sandy, Rich.
It's okay, John. We do not have a quorum. We will be executing these decisions at our board meeting on Wednesday, the 22nd, and report out after that board meeting.
Great, thank you, Sandy.
I'm here in my new seat, Mr. Adler. Thank you.
I'm sorry, who said that? I couldn't hear it. Oh, yeah, Mr. Orlando. Okay. Okay. Thank you all. So let me just review our schedule today. We're going to have the quarterly performance reporting this morning. Then we have then we have a KKR update. I didn't even know that. And then we have 2 real estate managers. Then we're going to break for lunch up here. And then the 2 funds that have hedge funds, police and fire, are going to stay up here to do the hedge fund presentations. Everybody else is going to go downstairs to the 8th floor to caucus. And then I think that police and fire, they're going to caucus. No, I see. Fire is going to caucus up here. Police is going to go downstairs to caucus on the 8th floor when they're done with the hedge fund presentations. Okay? And I'm sure there will be guides from the controller's office to make sure that we all get to the right place. And then just the one other announcement is that because of the date change, Scott Evans was unable to join us today. So he will be ably substituted by Mike Haddad and Alex Donier. Okay? So with no further ado, I'm going to turn it over to Mike to do the quarterly report.
John, if I could just ask for a moment of silence for Lieutenant Steve Sorga of Engine 6 right over here on Beekman Avenue. He succumbed to his WTC illness and is being buried today. Just a moment of silence, please.
Thank you. Okay, Mike.
Good morning. As John let you know, I have two roles today. I have my usual reporting on the markets, as well as I have Scott's role on talking about your individual returns. I'm going to do public markets and asset allocation, and Alex is going to do private market returns for the fourth quarter. So, markets in the fourth quarter. I'm going to break it into three parts. I'm going to first talk about the returns, and then trying to put a narrative to those returns, and then I have one last slide on current events, because it seems it's impossible to keep up with current events with every tweet and noise that comes out of DC. So, markets in the fourth quarter. Want to draw your attention to a formatting change, first of all, on this graph. On the fourth line, we've now inserted a new asset class, which three of the systems have adopted in their treasury portfolio, and that's the long duration treasury component. So that this will be part of this slide going forward. So I draw your attention to a few different things, a few things that stand out on this slide. And first, in the equities returns, you can see U.S. equities in the fourth quarter were up, while international equities were down a little bit, and EM was down the exact opposite of what U.S. was up. The narrative will get into this, but this all gets into the America First theme. And the second part of this, of the returns in the fourth quarter, have to do with rising interest rates. No surprise when rates go up, value of fixed income securities go down, and you see it very crystal clear as to what long duration did in the fourth quarter. It got clobbered. 10-year notes were up almost 85 basis points in the fourth quarter. The second Treasury line is the Treasury Agency +5. This is the old core +5 Treasury component. The duration on that portfolio is around 11, while the duration on the long securities is 18. So it fell, just not as much. And the other thing I would like to just point out is it highlights the degree of volatility in long duration treasuries when interest rates move. So this kind of was part of our rationale for going very slowly into the duration extension program that we've outlined for you in the past. So let me attempt to put a narrative to these returns. The title I chose for this part is Regime Shift. We certainly could spend a lot of time talking about it from a political standpoint, but we're going to stay focused on markets, although politics did drive the regime shift in markets. So starting post the election, markets are anticipating stronger GDP growth and higher earnings per share based upon some anticipated policy changes in three key areas. First, in business and personal income tax reform. I'm going to focus more on business tax reform, but that's what's got markets moving. So as you know, corporate tax in the U.S. is 35%. So there is a proposal to bring that down to 20% with a few changes to key items as well, and that is the elimination of interest deductibility as well as accelerated depreciation. So this is a big part of what's behind what I call some rotation within the equity market. So I've listed a few indices just to try and highlight this. So the Russell 2000, which is the small cap stocks, dramatically outperformed the broad index, which is the Russell 3. And if you looked at that even more carefully, the small cap outperforming large cap was even more dramatic. And if you look on a 3-year basis, it's been the small cap have definitely been underperforming, so this was a regime shift in markets that took place here. The second one is value dramatically outperformed growth. I'm showing it against the broad index, but if you showed that against the small cap, the numbers are even more dramatic. And this gets into the business tax reform that I mentioned. And this is part of that regime shift away from large cap international companies to more domestically focused small cap companies. So in this change, think about an Apple, large cap company, low effective tax rate, global business plan. GE, same thing, very low effective tax rate. global company. These companies were part of the large cap that have underperformed the small cap. When you think about small cap, think about Harley Davidson, domestic manufacturer, 35% effective tax rate, all domestic business. So it dramatically outperformed the large cap companies. The second place where we've seen some changes, some regime shift. So financials have underperformed the broad market since the global financial crisis. But with the election, we've now seen anticipation of a change in Dodd-Frank, and financials have dramatically outperformed the broad market. So just the ETF that I chose was up 21%, but if you drill down into some of the subcomponents, Goldman was up almost 50% in the fourth quarter, and even JP Morgan was up 25%. The other place where there's anticipated policy changes in energy. So we've seen energy equities outperform the broad index as well, and this was despite a down quarter for the oil commodity, actually. And then the last one, anticipated policy change in infrastructure spending. And this gets into a regime change, again, driven by politics. So part of this regime shift is away from fiscal austerity towards increase in fiscal spending. And specifically in the US, it's been about this broad infrastructure program and increase in defense spending. So the stock I wanted to highlight is Vulcan Materials. It is one of the few large publicly traded companies that's a proxy, if you will, for infrastructure. They are a leader in construction materials, so think concrete, gravel, asphalt. Their map is across mostly the southern U.S., but from coast to coast. And I know they popped up on a list recently about the wall on our southern border. But a good quarter for that company, which broadly represents infrastructure. So the other regime shift is away from a deflationary mindset in markets to an inflationary mindset. And you see that very clearly in interest rates across the globe. So in this slide, I listed a few key things that happened during the fourth quarter, but that's more historical than anything else. I'm just going to skip over that and show you a graph of what's moved in rates. So the first line is U.S., shaded there, and as I alluded to, up almost 85 basis points, the 10-year note. That's a big move, and you can see the jump kind of midway in between, which was the day after the election. On a global basis, similar thing. All developed markets higher in yield, and this gets into the regime shift of away from fiscal austerity and to fiscal spending. So there's plans in all these different countries to increase fiscal spending, with each country having its own idiosyncratic reasons for doing so. The other place we're seeing the manifestation of away from deflation to inflation is inflation break-evens. So very simply, inflation break-evens are a representation in financial markets of anticipated changes in inflation. The math behind it is very simple. It's the nominal yield versus the Treasury inflation-protected yield, and the difference is the market's change in expected inflation. So in U.S., it was up almost 36 basis points in the fourth quarter, which is a big move. If you took this line further back in time, you'll see it kind of stabilized around a 2% inflation rate, maybe a little bit higher. And with the collapse of oil in 14 and 15, that's when we made our lows, and now we've been gradually moving higher. And again, this is what the markets anticipate in terms of change in inflation. Again, not just a U.S. story, a global story, and you can see inflation break-evens higher in all these different countries. The dollar in the fourth quarter had a big rally as well, up almost 5.5%, with the key contributing factors listed on the slide. And there's a lot of different ways to measure the dollar. The one that I prefer to use is the trade-weighted dollar. So this is the dollar measured against our trading partners. And as a reminder, our three largest trading partners are China, Canada, and Mexico. So when you think about those three currencies, we know China's got a whole bunch of issues. They devalued a couple times over the past years, so the dollar is strengthened versus there. The peso, I think we all know the story there. It's had a really rough couple years, so the dollar's rallied significantly against the peso, and Canada is now facing its own set of issues as well. So on a trade-weighted basis, the dollar has strengthened quite a bit. Just in terms of perspective, if you draw this out and go back since 2000, you can see the dollar is at or near its all-time high. So why does this matter to markets? A couple different reasons. It's a broad way of thinking about the financial market's confidence in the U.S. And as uncertain as it is, the policies anticipated policies are better for growth, they're better for earnings, and we're attracting capital into this country from an investment standpoint. On the other hand, it's negative for exporters, it's good for importers, and all things being equal, it slows growth and inflation a little bit. But as we've talked about, that was not the theme in the fourth quarter. Before I go into current events, let me just pause if there's any questions or comments on Q4. Okay. Yep.
There was a lot of talk about an infrastructure spending in the wake of the election, but here we are at the end of the first quarter, and it's a nothing burger. There's nothing there, from what I've read and probably what we've all read. It may not be done at all, or at least not into next year. So I'm just wondering, as you take us forward, it'll be interesting to hear what you have to say about that.
And that ties into one of, I think, the current issue. As we're seeing the healthcare debate and the House trying to pass this bill, recognize how messy legislation is. And the Republicans, while they control both houses, they are not a united party. If Ryan, he's got to get the Freedom Caucus on board to get healthcare, and without them, he can't pass the bill. So that speaks to markets. If healthcare does not get through the House or doesn't get through the Senate, all these anticipated policy changes are going to be called into question. So what I kind of listed on this slide is the probability, timing, and specifics of those. And then to your point on infrastructure, it seems to be the lowest priority. And then there's how they're going to fund it. Is it some public-private partnership? And so that's just more hair on it and further reduces the timeliness of it. And again, the guy in charge, you just don't know how to handicap him. It's just, there's a new tweet every day, even more so on Saturdays. But, so the other big question, which kind of flowed out of this weekend, is the impact on the economy and markets of trade and immigration. So I'm referring to as the G20 meeting, which ended this weekend, and it was. It's on the headlines in the financial papers, but not there. And it was really a break from almost a 20-year tradition, not a tradition, of a unified stance amongst the G20 about positive trade, no trade barriers, and the emphasis on that. And the new Treasury Secretary would not sign off on that. Our foreign partners would not sign off on what he wanted. So we've ended up with a very fractured G20 statement. And again, not an impact on markets today, but historically, if you go back, when there's been broad dissension within trade policy on a global basis, it has resulted in tremendous uncertainty and volatility in financial markets. So I would highlight that as a major source of concern going forward. The Fed, they've been on the front page, the business pages recently. They raised rates last Wednesday. And what markets are still faced with is the pace and the magnitude of interest rate increases that are coming. And then also a major change in the composition and leadership of the Fed. So there's 7 Fed governors. 2 of those seats remain empty. So the process is the president appoints, the Senate confirms. So Trump is going to get to put 2 new Fed governors in, as well as the Fed chairperson and the Fed vice chair's terms expire in 2018. So he's going to get to appoint those people as well. And we've had we've had Bernanke, we've had Yellen, and they've been both very academic-focused, strong believers in Keynesian economics. So what we get after this is just another piece of uncertainty for markets to deal with. And on the international side, I point to both the political risk in Europe. Although all things being equal, that's gone down a little bit with the Dutch election last Wednesday. It was not the populist who won there. It was more the pro-European person. Still elections ahead in France and Germany. And the last part is quantitative easing in Europe and Japan is still at full throttle. It is at the maximum point where it's been since the global financial crisis. And I would think markets are going to have to get their arms around positive growth and more positive inflation in those two countries, and the potential for those programs to come to an earlier end than anticipated. So the ECB met on March 9th. It was apparently a very fractured meeting with disagreement between core Europe and peripheral Europe. They didn't make any changes, though they did acknowledge that growth has picked up. So what markets are looking forward to is the June ECB meeting, which will be after the French elections, and for some type of potential change in the program there. So that's it for markets. Again, I'll pause for a second before I go into individual systems returns.
Questions for me?
So if I was doing the real Scott thing, I would put on the little microphone, I'd walk around and point to things, but I'm not gifted to do that, to walk and talk at the same time.
Just don't walk behind me.
I think that's part of the reason we changed your seat. So these are the returns of your individual systems, and the systems are ranked by portfolio volatility, so there's no change there. And we're comparing your systems returns to the medium TUX return. And again, the TUX is the benchmark for all public pension funds. And as TUX reports fees gross of public, net of private, that's how we presented your returns here as well. Fourth quarter, all the funds were either at or slightly below TUX, but on a 3- and 5-year basis, all systems are either at or above TUX. The bottom line is index portfolio, 65% equities, 35% fixed income, and you can see on all time series, each of the systems have outperformed the totally passive index. Same format, but this slide shows your returns net of all fees. All the slides going forward will show returns net of both public and private fees. So the next 4 slides are on asset allocation and on your portfolio's mix relative to your asset allocation. And for this quarter, we're showing your policy mix versus your old asset allocation as well as your new. I find the old, comparing versus the old, really not relevant. So I'm going to skip through the old ones and just go right to the new ones. So this slide is policy versus actual asset allocation for both equity and private markets. And you can see domestic equity, that both police and fire are overweight U.S. equities, underweight developed markets. And this was as of DEES 31, and there have been trades in the first quarter to bring those policy weights closer in line. And I will say that there are no active tilts in the portfolio. We are doing everything we can to get you in line with your allocations. Not much else going on in this slide. BRRRR is a little bit overweight EM, and there's some trades that have taken place for that as well. In fixed income, there's a lot of dispersion away from your allocation here. So let me take a moment to explain this. The first column, if you will, is cash. So we're showing you what your cash levels were as of DEES 31, and as a reminder, your policy weight is 0. So we are working hard to keep that policy to get you back down to 0. The old Core Plus 5 or structured bond portfolio, we've broken down into its subcomponents. So we have treasuries. Further on to the right, we have mortgages and credit. Treasuries, we've further broken down into 3 categories. We have the Treasury Agency, which is the old Core Plus 5 component of your Treasury portfolio. As a reminder, that's the duration of 11, and that's the longest part of the Treasury portfolio for 2 of the systems, NYSERS and BRRRRs. The third column is the second column, I'm sorry, third column is the short-term treasuries. And this is kind of a parking place for while we're doing the fixed income implementation plan. We've talked about the duration extension plan, and while we're in the process of doing it over the next few quarters, we're going to have the proceeds from mortgages and credit residing there, and that's why all those bubbles are above their policy weight, and why in the fourth column, the long-term treasuries, all of those bubbles are well below their policy weight. So again, this is the duration plan in motion over the next few quarters, and that will all get ironed out.
Mike, can you just define short-term treasury on this?
It's the passive 1 to 3 year account that we spoke about a couple meetings ago.
And then, so what's cash? In other words, cash used to be anything below 4, I think.
Cash is what resides on our desk internally. So we wanted to break it out separately because the short-term treasuries is part of your big picture fixed income portfolio and is on its way to long duration. So we wanted to break the two of them out. Investment grade credit is all showing policy weights slightly above. Again, this was a snapshot as of Dec/31, and the fixed income team has been busy, and that's going to be closer to policy weight when we're up here 3 months from today. Take a second on high yield. All of the systems increase their allocation to high yield, so thus you're seeing the numbers are below the policy target. We are in the midst of doing a high yields manager search, which we expect to get done in the fall. And in the meantime, we wrestled internally what to do with the proceeds, the unallocated proceeds. So the rebalancing team, in conjunction with some help from Wilshire and our own risk team, has gone through a detailed analysis of using existing public assets as a placeholder for high yield. So we've just wrapped that up, and you'll be hearing from us shortly with a BAMogram on what we've recommended. And not much going on in the other asset classes here. So let me jump into returns. Again, your portfolio versus your benchmarks equals your excess return. Not a lot going on here. And I will say that these returns are versus your old asset allocation, so there's going to be some benchmarking issues that are going to come up throughout this. Excess returns can be defined as excess returns from asset allocation or from manager value added. Again, not a lot going on in either one of these, but I'm going to delve into both of them a little more thoroughly. This slide shows excess returns from asset allocation is broken down by equity and is broken down by fixed income. So in equity, you see teachers with a little bit of negative excess return from asset allocation, and this gets into the benchmarking and the timing problem that I spoke about. With the equity portfolio in teachers, we were more active in the third quarter, adding to emerging markets, adding to international equities, reducing U.S. equities. And if you recall from my first slide on markets, what happened in the fourth quarter in equities? U.S. was up 4%, EM was down 4%, so this is just a timing issue. This will all come out in the next slide. In fixed income, we benefited from the same timing issues. We were active in the third quarter reducing mortgages. Mortgages had a return very similar to treasuries. So since we had reduced those and shortened duration, we benefited from that timing issue. As well as in the fourth quarter, your old asset allocation, we were overweight high yield. High yield was up in the quarter, so again, just a timing issue on how we report things. So this is the slide with your manager value added for the entire portfolio. Again, not much going on in the fourth quarter. 3 year, we're still trailing, and that's what keeps us up night on the 8th floor. This slide is your excess value added from your total U.S. equities portfolio. And as you can see, as the weightings on the right, this is a big chunk of your portfolio. Fourth quarter, we're happy to say that manager value added was all positive, though still slightly trailing in the third quarter. I'm sorry, slightly trailing on a 3-year basis. And then I'm going to go into a few slides here with some specifics components of your portfolio. Again, as it's public session, we're not going to mention manager names, but happy to do that in executive session and with the help of our equity team. So here, this is your mid-cap equities, U.S. equities portfolio, and you see teachers with a big positive excess return. Again, another benchmarking issue. Your mid-cap portfolio is indexed to a Russell index. One of the managers in your portfolio is a passive manager who's indexed to the S&P 400. The S&P 400 dramatically outperformed its Russell index, and thus the large outperformance. And I'll mention in the first quarter, we rebalanced your equity portfolio, your U.S. equity portfolio, to be cap weight neutral to the Russell 3000, as well as some trades out of U.S. into international. As a result of doing those, this manager is no longer in your system. So this is going to go away. Fire, where are you guys? You guys moved. Your portfolio is showing a negative bar here. So one of the managers here, who's both in police and NYSERS, you have a higher weighting to them, and in the fourth quarter, they were underweight banks and energy companies, which had a big rally. We still have high conviction in the manager, but that's the root cause of that underperformance. So this is manager value added for small cap. A negative performance, fire and teachers again here. And this gets into one of our managers who runs a very concentrated portfolio. They underperformed the fourth quarter, same reason. This rally in the deep value stuff caught our managers slightly behind the markets. I will say that we still maintain high conviction in the manager, as evidenced by their over 400 basis points net of excess returns over the inception, and you see that in the longer term numbers. This slide is international equities, the growth component. Not a lot going on here, but just wanted to mention that growth was down in the quarter, and our managers all slightly outperformed, with the exception of Burrs, who just has one manager who in that area. This is in contrast to value. This is international equities, the value component. Value had a strong quarter. Our managers underperformed, and again, this is a couple managers we have here that we have very high conviction in, just didn't catch some of the deep value and the junkiness of if you will, of the rally in the fourth quarter. One of the managers, two of the managers we have high conviction in. The third one we do as well. That being said, the equity team is going to see him at the end of the month just to check in. Manager value added in our structured fixed income, largely indexed portfolio, so we don't expect to see much excess return there, as evidenced by the small numbers in both fourth quarter and the 3-year. This is your ETI portfolio. So we've talked about this with you before. This is a mismatch in duration of the portfolio versus the benchmark. As a reminder, the ETI's portfolio is roughly 8.9 years, the benchmark 5.5. So in a falling rate environment, we would expect a longer duration to outperform. In a rising rate environment, we would expect ETI to underperform. So this is as expected. But still in the 3-year trailing numbers, very positive. Last slide for me is this is hedge funds. So we had a good performance in hedge funds in the fourth quarter, and a little bit of story behind there is a couple of the managers who had underperformed in the previous quarters, one a long short equity firm, one an event-driven firm, did very well in the fourth quarter. Another positive contributor was our one developed market discretionary global macro firm, did very well in the fourth quarter. Negative contributors came from our systematic trend following managers. So let me pause for any questions or comments there before I turn it over to Alex for private markets.
Any questions for Mike? Okay, thanks, Mike.
Good morning.
Alex, sorry, before you get started, we do have a representative from the SBA. If you could just introduce yourself for the record.
Vincent Vallelong, SBA, proxy for Mullins. Also, Bruce Monahan, designee Roy Rick, CPA.
I think we have a couple new attendees from Borough Presidents too, if you could just introduce
Yes,
yourself.
Angelina Martinez Rubio, Queensboro President's Office.
Ray?
I was here for the roll call.
You were? Okay, sorry. Everybody else? Any other new trustees who've arrived since roll call? Okay, thanks.
Good morning. I'll be going through the results for the private asset classes, and I will also do OFI. First of all, we begin with private equity. Just as a note here, what we're looking at is returns since inception as of Q3 of 2016, as we're on a lag in the private asset classes. You'll see for private equity, quarter over quarter, the results here reflected since inception have been, fairly flat. You have 3 systems in police, fire, and BRRRR that are performing above the benchmark, which for private equity is the Russell 3000, but still below they're performing above the PME, which is the Russell 3000, slightly below the benchmark, which is the Russell 3000, plus a 300 basis points illiquidity premium. Teachers and NICERS are slightly below benchmark. And it is important to note that if you were to break this down as we do in your individual reports into relationship types, the primary relationships which have generated returns for all systems well in excess of the benchmark, the Russell 3000 plus 300, continue to make up a greater share of the portfolio, and that's currently at about, let's call it across systems, 54% of NAV. So we continue to see strong performance from our primary relationships. Now moving to real estate. First thing I'll mention about real estate, we're beginning this quarter to now break real estate into both core and non-core. Here we're reflecting the performance for core since inception. You'll see NICERS, police, and fire slightly below the core benchmark. Teachers being flat to the benchmark, and BRRRR is well above the benchmark. And I will note there that BRRRR benefits from being having the youngest real estate portfolio and benefiting from the strategic initiatives that were launched post 2010. Now moving along to non-core. You will see here again the results for non-core. You have NICERS and police just kind of at benchmark, fire slightly below, BRRRR for the same dynamics mentioned on the core slide, strongly performing, and teachers are also showing a strong performance, although that is driven by one partnership in the teachers' real estate non-core portfolio. Jumping to OFI, just one quick thing here on the dates. OFI is reflected as of the 4th quarter of 16, as opposed to the other private asset classes, which is 3rd quarter of 16. I think the big point to mention here is that sequentially, quarter over quarter, for those systems that participate in OFI, you're seeing sequential improvement, and that is driven by improvement in energy credits. So as you're seeing the sector rebound, you're seeing that reflected in the returns in your portfolio. And lastly, but not least, we have infrastructure, which continues to perform strongly. As we've mentioned in the past, it's still early for the infrastructure portfolio, but I will note that you're starting to see the results moderate. You may remember in prior quarters, some of these results were above 1,000 basis points because they were such new funds. So you now are starting to see the normalization of the performance and infrastructure as these funds mature. But infrastructure continues to be off to a strong start there. And that is your update in private markets. Any questions? Thank you.
Thank you, Alex. Okay, so that's it for performance updates, right? So now we move to the risk update from Miles.
Hi.
Miles, you should put the mic up. Yeah. Thanks.
Okay. So I want to spend a few minutes talking about a couple of the initiatives that the risk group's been focused on for the last year. This is going to be fairly brief. You're going to hear a lot more from us next week when we talk about in more detail the risk analytics RFP. So the first thing that we're going to cover today is just spend a little bit of time on progress we've made staffing up a risk group. When I joined in 2015, basically the group consisted, shortly after I joined, the group consisted of there we go. Of myself, Dan Haas, and Sherma Cooper. In 2016, we've hired a number of people. First off, we hired Nick Radev. He joined in February as a senior investment analyst. He joined after completing his master's degree in financial engineering at Stevens. It was particularly gratifying to be able to hire Nick because he came through the controller's internship program. We got to know Nick over the prior summer. We then hired him part-time during his last semester in academia, and then he joined us immediately after graduating. Chris, we hired a guy called Chris Lusk as an applications developer. You'll hear a little bit more about what he's done in a minute. Some of the stuff he's been working on. Prior to working at BAM, he was at Merrill Lynch. And then the other hire that we made is late last year we hired Alex Dotov. He joined the team in December as a senior investment officer. He was previously a managing director in the office of the CIO of New York Life. So just a little bit of insight as to what the various individuals are working on. You're going to hear in a minute about the risk RFP. Sherma was just, her contribution was invaluable in terms of getting the logistics of that going. Working with the contracting group, making sure that all of the meetings and information was passed to the various vendors that we were evaluating, and generally kind of trying to keep the process on track. Dan's background is in fund accounting and his familiarity with the way that BAM works has been invaluable in terms of him. He's needed to, on multiple occasions, explain how things work here to me. As I've learned about the New York City retirement systems, but he's also made a significant contribution to the risk RFP. And Chris, you're going to hear a little bit more about some of the stuff he's been working on. Just a very focused, productive individual. Alex, who joined the team later on, his contribution, I think, is going to become, it's already been invaluable. But as we, in terms of evaluating the various risk systems we've been looking at, he's made a substantial contribution. And once we move to implementing one, his familiarity with 2 or 3 of the systems that we're looking at closely is going to be, I think, extremely useful. And then Nick has got the quantitative background that will be very helpful as we implement one of these systems. We all have some familiarity with the models that are embedded in these systems, but Nick is well, his quantitative abilities are significant. Anyway, so with that, I wanted to move on and talk a little bit about something that we've developed internally. It's not a risk system per se, but it's a useful set of reports that we now generate. We refer to this. So basically, what one of the things the risk team has done over the last year is create a data warehouse. It's hosted on servers right here in the municipal building. We take in data from every night from the custodian, which is holdings data, as to the NYSERS investments. We take in basically accounting information at the end of each month. Again, from the custodian, the books are closed on the system's results on a monthly basis. We also take in a lot of data on the holdings that the systems have. This is static data, which is not available through State Street, that we pull in from Bloomberg. So we take all this data and we join it. It's not as trivial as it sounds, because the structure of the through which New York City pension systems make investments can be complex. There's 5 legal entities. Well, 5 systems, yet there are 6 legal entities that make investments. The holdings data that we get every day is per 6 legal entities. So we have to take that apart and and assemble a reporting package that is essentially real time. We are able to look the next day, the day after the close of trading, at these reports. They're not
I'm sorry,
risk
can you
reports.
just clarify, what's the sixth entity?
Oh, it's called a group trust. It was a commingled vehicle that was set up to, largely the motivation was to make equity investments outside of the U.S., but there's a lot of other investments that go through it. So we don't get, when we get holdings data every day, it's allocated to 6 legal entities. So if we want real-time reporting, we need to untangle that. Anyway, rather than making this a totally abstract discussion, I'll show you a couple of the, again, it's not a risk system per se. It's basically a viewer that allows us to take different cuts of the data assembled in this database. So it's just about allocation of NAV across asset classes. It's about performance. It's about breaking out certain characteristics of the investment per this static data, but it's not a risk system per se. We'll get to some of the functionality of a risk system in a minute. One of the reports that it generates, you're probably all already familiar with. It's a graphical representation of the asset allocation that Scott, I think, discusses at virtually every SIM. This is one of the products of the BAM ribbon. We can now generate this every day based on yesterday's holdings. We were never able to do that before. The next couple slides I'm just going to zip through quickly. The point isn't really to talk about any of them in detail. It's just to make you aware of the type of analysis that's available basically every day now in virtually real time. This is just I call it P&L. It's change in value of equity investments versus fixed income investments broken out by system across various time intervals.
So I just want to clarify.
Sure.
You're getting updates through your vehicle from both State Street and Bloomberg, and you're reviewing all this information based on our investments, right? And you're close to, I'm not saying you are, close to real-time observation of our performance at any, on any day.
That's exactly right. It's the next business day.
Next business day, okay.
Which we've never been able to do before. Our analysis performance was always lagging by months in some instances.
Right. So it's not based just strictly on, as it was before, State Street's unscrubbed numbers and stuff. You could actually update yourself based on this vehicle that you can start looking at against Bloomberg and other I guess, information reporting, right?
That's exactly right. We actually still rely on prices that State Street pulls in from multiple different vendors to mark the holdings to market, but it's assembled by system within 24 hours of the prior trading day, which that analysis we've never been capable of before.
And it's probably obvious, but we mark public securities daily off this. We don't mark private stuff daily.
Sorry, that's absolutely right. I mean, we're still subject to the marks that the private asset GPs put on their holdings, and there is a lag about that. Further to that.
Just, I know that's not part of your presentation. Roughly, how much of a lag do you have on the private market?
It's at least 3 months.
At least 1 quarter.
1 quarter.
One could model something that looks like it and adjust it, and we found that exercise not working.
Anyway, so we do breakouts, by, sorry, hitting the mic. We do breakouts basically of the equity portfolio. This isn't just one. There are literally dozens of these reports. This is one I selected almost at random. It's the active risk. It's the risk that the NYSER's active managers are taking versus the Russell 3000. It's broken out by various different characteristics of equity investments by industry, market cap, P ratio, dividend yield. Similarly, when it comes to fixed income, we can do a number of different summaries of the type of fixed income investments we've made, broken out by system. But where the first level sort is by a characteristic of the fixed income investment that's important, either be it NAV, that's an asset allocation within fixed income representation, but duration, yield to worst, DV01. Yeah. So rather than go through multiple versions of these reports, in fact, the reason for bringing this all up is I wanted to make you, the last one that I want to show you is really the reason for bringing this up today. When we went through the asset allocation exercise, the most recent one, Scott advised you all that we were going to be bumping up much closer to the basket limit than we had previously. So it became important to be able to analyze this basket limit, our proximity to it, and Scott obliged that we would create a process by which we would monitor it and report to you as we approached it. So that's really what is on the last. This is one of the reports that we generate. This is something that is of use to Mike, who chairs the rebalancing committee. This is just a breakout by asset class of the investments that each system has made, again, available the following day. The day following trade activity. And on the last line of it, you can probably barely read it. And again, the point is not really to drill into the report right now, but there's a line which says basket assets. It shows the limit, 25%, the amount utilized. So this report, so now I'm going to start referring to the process that we've put in place. Now that we generate this report, it's incumbent on me or our risk team to generate this every day. It's reviewed by the Financial Reporting Group, and then at certain, as we approach the basket limit, there are certain steps that we're obliged to take. At 23%, I have to go talk to Mike. 24%, we've got to start developing plans. 25%, we have to have very specific steps in mind, and we're obliged to immediately come. Scott's obliged to immediately come and explain to the trustees that we have reached, were we to ever get to this point, breached a basket limit, and explain to you what steps we're going to take to remediate the breach. So the last thing that I want to spend a few minutes talking about, you'll hear, as I said, a lot more about next week, at the next SIM, and that's the Risk Analytics RFP. This is a really major initiative for all of BAM, I think. The point of the RFP is to procure software which is both enables us to analyze the risk of a portfolio of investments at a point in time, and to analyze the returns that portfolio generates over time. So those are two functions that we require of a risk system. The first is in the jargon of the trade referred to as a risk system. The second function is referred to as an attribution system. The platform that we're seeking to procure will perform both functions. Another important objective of the RFP is to procure something that's useful to us. And when I say useful to us, I mean the risk team, in that it will enable us to fulfill our obligation to generate risk reports to share with you, to share with BAM's investment committee, the CIO, the deputy CIOs. But the other objective of the RFP is to procure something that's useful to the risk team, to the asset teams in their role as asset allocators, to enable them to analyze the return of either a prospective manager or an existing manager. So the software needs to be capable of sort of top-down analysis. I won't define it today, but the type of models that are used to perform that are typically what are called factor models. But the other characteristic, so that's a kind of a top-down analysis of the portfolio. But the other type of analysis that we think is critical is really from the ground up. We want to be able to perform much more granular analysis of what have been heretofore relatively opaque investments, such as the investments in many of the private asset classes. In the case of private real estate, we want to know every holding, every investment that a GP makes. We want to know the name of the company. We want to know what industry it's in, what location it's in, how much leverage is on it. In the case of private real estate, similarly, we want to know every building. We want to know what type of building. We want to know the location. We want to know how much leverage is on it. And we want to know information. We'd like information about the rent roll. So in order to prepare for the risk RFP, I just want to mention that because it's taken a long time to get to this point, we wanted to familiarize ourselves with the type of analysis that one can do with a factor model on holdings that were representative of one of the New York City pension systems. So we loaded the holdings of one system, the smallest system, into Bloomberg. Bloomberg recently has made a factor model available through their terminal. And we, over a period of months, we now have a monthly portfolio review session. And at several of these monthly review meetings, we reviewed analysis that we performed with a factor model on one of the New York City pension systems. And I mention this only because it was excellent preparation for us diving into the risk RFP and enabled us to ask the sort of questions that I think were important of the vendors. So the final slide on the risk RFP is really the timeline. So basically shortly after I got here, Dan and I started conducting due diligence. In August of last year, we issued the RFP. We got responses from 8 vendors. We were very gratified. We subscribed to research put out by a investment technology-focused consulting firm called Cutter, and they're sort of the name brand in that space. And we were gratified to see that we got responses from basically the 3 or 4 top rated vendors by Cutter. We scored the various responses in December. In January, we winnowed it down to 4 through the initial scoring. We subsequently took another look at it, got it down to 3, and then one of the things that we did, again, one of the things which has caused this process to take some time, is we decided that before buying anything, we wanted to use it. In prior lives, I've been responsible for procuring derivative trading software from third parties. And the one lesson that I took away from that is that you never buy anything based on the promises of a software salesman. You need to use it, and you need to use it on something that's representative of your holdings. And what we did is we took this holdings, this database that we've assembled that was required to make this BAM ribbon available, and we passed the holdings to the 3 finalists, a year's worth of holdings to the 3 finalists in the risk RFP. And we basically asked them to make a trial available to us for a period of, in the end, it was only 2 weeks per vendor. We wish it had been longer, but we need to get on with life. So we had sequentially 2-week trials of each of the 3 finalists. We've had a 2-week period at the end, which is just finished, which enables us to compare the various systems and answer any remaining questions. So we are in the process of preparing a memo, which you'll all see shortly. We're going to be discussing it at the next BAM Investment Committee meeting. And then, again, going over the recommendation with you next month. I've got here sort of probably somewhat optimistically the hope to execute a contract in May, and then I put implementation is taking from May to September. That may slip. These are very large systems, but we do hope to have the thing up and running by the end of the year. Anyway, that's, sorry, all I have. If there's any questions.
Questions for Miles? Yeah, Dave.
So, Miles, I have 2 questions. Number one, we get monthly performance reports. Will the application that you either already have or the applications that you're working on getting speed that timeline up? Because there's a long lag between the data and when we actually get it in the monthly report.
Certainly the reports generated by this internal application that I mentioned, I doubt Susanna's going to be very happy with us, or anybody in the controller's staff in well, I shouldn't single her out, but they're not audited. They're not audited, so there's going to be a lot of hesitation about making them available. With regard to the results that are going to be pushed out by the risk system, that's, I think we need to collect our thoughts on that. Again, they wouldn't be audited.
Right.
So there's a hesitancy to, I don't understand all the niceties of that. Susanna can help me.
And we can certainly discuss offline the best way to get you the information in the most timely way.
Thank you.
Yes. Joe? Oh. Okay, Charlotte.
Yes, thank you, Miles. Is there an overarching cost-benefit strategy that you have in this undertaking?
Well,
I know how sensitive we are to fees and costs, and
I think we have to be conscious of cost, obviously. The Controller's Office hasn't heretofore spent money on systems like this. I think that my own view is that the cost of something like this for a system of this size, without it, I think we're almost flying blind, particularly when it comes to some of the alternative investments. So I don't know how to say what an appropriate expenditure is. I think that, I guess Scott was most insistent in discussions with the procurement officer that we make the initial screenings and recommendation without paying any attention to cost. In other words, he wanted us to evaluate what we thought the best system was, given the type of reporting that we all felt was appropriate. I think we're going to be gratified in that the system that I can't name, because I'm not going to name the system that's the leading contender right now, but it's not the highest cost system that's available. And we will, at the next month's sim, absolutely get into what the costs, what the costs of all of the finalists were.
Right, and I'll just remind everybody that the necessity of having such a system was definitely outlined and recommended in the Funston report as well.
You know, Charlotte, I would add on what the two things that we really do on behalf of the systems is asset allocation and manager selection, and the tools that this will give to help us in both of those is to quote a commercial, priceless.
Ray?
Hi. Spinning off something that my dear friend Joe Alexandro said, how do we properly evaluate risk or have risk metrics on an alternative investment like a private equity investment, which may not even be marked on an annual basis or even less?
That's actually something that we will be able to spend a little bit of time on next month. I think that the important thing there is that is to be somewhat skeptical of the marks. They are dampened relative to the marks of public equity securities. So one of the things we're going to talk to you about is trying to understand what the real volatility of in particular, private equity investment is. And there are techniques that some of these vendors use that are called de-smoothing techniques, which basically enable you to try and guesstimate the actual volatility of a mark. And that's important if you want to move towards a kind of a risk budget based on VAR or volatility. So that's one way. One response is to use this analytical trick called de-smoothing. Basically, we want to get away from assigning a simplistic benchmark to a private equity investment. We want to actually procure a system that will enable us to actually go through and look at each of the portfolio companies and map that to something in the public market space, and then use factor analysis, analyze it as if it were a portfolio of public market securities. And again, we can spend more time on that next month.
If you're doing well enough, you can market it. We can provide services to other funds.
We got a lot to learn on this, Joe, before we hit the road, I think. But, yeah.
Joe, did you have another question?
No.
Okay. Others? I'm just going to call myself. So
Mr. Adler, do you have a
Mr.
question?
Adler, thank you, Miles. So let me just say that I have felt the lack of a risk monitoring system was practically, no, I don't want to say this, was sorely missed here. And, you know, as a trustee, I feel like we need a sophisticated risk monitoring system in order to properly do our jobs. And so I want to commend Miles and the team at the Controller's Office for engaging in this process. And I really want it to move forward as quickly as possible. I'm not saying don't do your diligence, but frankly, every day that we don't have this risk monitoring system, especially given the volatility that Mike talked about before, I feel like it's a day where I wake up nervous that you know, the undisclosed risks in our portfolio are going to come back to bite us today.
Certainly, the reference calls that we conducted amongst other large pension systems were eye-opening for me. We, amongst our peers, would seem to be alone in not having this type of ability. And what was eye-opening was not that we were alone. I kind of knew that, but almost every single one, we wintered it down to a series of semi-finalists, and each one has certain characteristics that, you know, the other doesn't have. So, yeah, but we have to. We're trying to do one procurement or procurement of one system or not much more than one system, but many, if not all, of the reference checks we made to large systems, not even as large as ourselves, in every instance they've licensed 2 or 3 of these things. You know, they have one system that they think gives them an edge in analyzing equities, another system that's better at total plan risk. So anyway, it's definitely the case that our peers have historically spent more money understanding what they're investing in than we have.
Yeah, and I've seen risk dashboard presentations that other trustees at other pension funds have, and I'm like,
well, we do have to work with Susanna to make sure we're all in sync in terms of the timeliness of what we can show you, but you will definitely be seeing discussing with you a potential format of risk dashboards.
Okay.
Even if we, and I have to echo what Mr. Adler just said regarding a dashboard and information. Even if you put a disclaimer on the top to the trustees, you know, this information is not completely up to date, but it's I think you can't go wrong by updating the trustees quick enough.
A major motivation for this, Joe, and there are issues we need to work through in terms of timing, is to provide you with risk reports that you have not gotten heretofore.
Okay. Other questions or comments? Okay. Miles, thanks very much.
Okay.
Sure. So let me just say. So we have a request from BAM to add an item to the agenda. It's a little bit out of the ordinary, but if there are no objections to having Mike Garland come up and do a quick presentation and request, we'll allow it.
He is.
Okay, Mike.
Okay, John, before we go forward, we have one more arrival. Corey, if you could just get your name on the record.
Corey Grable, PBA.
Thank you, Mr. Facilitator. And it may be out of the ordinary, but it's straightforward, and I will try to be very brief. We just have a request that we would like the New York City pension funds, collectively all 5 funds, to be a signatory to the Carbon Disclosure Project. It's a long-standing international nonprofit that collects data on carbon disclosure from companies around the world, and they've expanded to also do rainforest disclosure and water disclosure. NYSERS and teachers have been signatories for many years. This year, CDP changed their model, and so they're charging for signatories. It's, I think, $975 if you have over $1 billion in assets, or they have a membership program where you get more tools, and that's $9,000 per signatory. We've negotiated with CDP the one fund membership. They would take us collectively across all 5 funds for $975. And I think the key reasons that it's important, A, the disclosures that CDP asks for each year from 6,000 companies around the world are consistent with the existing disclosures we support through our proxy voting policies. And the information collected, particularly on carbon, is the primary source of data for the carbon footprint exercise that all the funds are now doing. So we've hired a vendor to do that. Many companies disclose through CDP, and where they don't disclose, the vendor has to make an estimate. So the recommendation or the request is that we sign on, include all 5 funds, and then split the $975 per year on a pro rata basis. Any questions?
So just from a going forward standpoint, rather than ask all 5 of the funds to vote right this second, because it would take calling 5 different rolls, if we're all in consensus around the table, we can take the formal vote in the caucus. But you know, if that's an appropriate way to move forward, in a timely way to move forward.
So I think the way to do this is to see whether there are any trustees, and if you do object, I think you should feel free to say so. Are there any objections from any of the trustees at any of the funds?
I just want to point out.
Yeah, Joe.
My president has said that global warming is a canard, a complete lie, so I'm not sure if we want to.
Which president?
Exorbitant fee, so.
I think that was a joke. For the record, I think that was a joke.
You know, I have to go with what he says.
No, but the exorbitant fee, I think, was a joke.
Joe, Maddie or Trump?
Yeah, which president?
Okay, so are there any objections? Yes, a question, Mr. Gennardis. Andrew Gennardis.
Andrew
And use
Gennardis,
the mic.
NICERS. Would the name be listed just as New York City Retirement Systems, or would each of the funds have their names listed separately under that bulk purchase?
I think we were going to do it collectively as the New York City pension funds. If there's a request to engage otherwise, we can ask them. But what we had talked about was doing it collectively as a system, systems.
Okay, any other questions? Any objections? Going once? Going twice? Okay, Mike, you're good to go. Thanks. John, let me just clarify something. So you want that vote ratified in each of the caucuses today?
Given that it's an expenditure, I would look to the executive directors on whether or not that would be the appropriate way to proceed. But I think it makes sense to just ratify it as it is an expenditure.
Okay. All right. Thank you. Okay. With that, I think we're going to take a short break. Have I got that right? Okay. We're going to take a short break. Time is 10:23. So let's be back ready to go at 10:33. We can actually stay on schedule today. Okay? Oh, shoot. We have to go into executive session. Let's do it when we get back. That's fine. Yeah. Okay, so remember, we're going to go into executive session when we come back from the break. So I'd ask members of the public and the press to exit during the break. You can take some coffee on the way out. Thank you. Concludes our public agenda business for now. So votes to move into executive session by each board will be in order. So let's start with fire. Need a motion?
Are they back?
Is there a motion from a fire board member to go into executive session?
Fire moves to move into executive session.
Is there a second?
Second.
Okay, motion made and seconded. Any discussion? All in favor of the motion of fire to go into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Police, can we get a motion to move into executive session?
Motion to go into executive session.
Thank you. It's a motion made and seconded. Any discussion? All in favor of police of going to executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Was that a nay? Okay, motion carries. Teachers, is there a motion to go into executive session?
So moved.
Is there a second? Motion made and seconded. Any discussion? All in favor, teachers are going into executive session, please say aye. All opposed, please say nay. Any abstentions? Okay, motion carries. The teachers, NYSERS, is there a motion?
So moved.
Is there a second?
Second.
Motion made and seconded. The motion was by Andrew Gennardis, and the second was by Ray Sanchez. Let me just remind folks, actually, to identify yourselves when you're speaking, so the transcriptionist knows who it is, because it's very hard to see around the table. Anyway, at NYSERS, we have a motion made and seconded to go into executive session. Any discussion? All in favor at NYSERS going to executive session, please say aye. Aye. All opposed, please say nay. Any abstentions? And let me just note for the record at NYSERS that Patricia Stryker from Teamsters 237 has joined us. Okay, I think all four boards are now in executive.
Okay.
Mr. John Adler?
So hold on, Lee, we're just calling into order the public session of the Firefighters Variable Supplement Fund, so we'll ask for a roll call.
Mr. John Adler?
Bill Dukes, with
Has
John
his-
Adler's proxy.
Yeah. Ms. Susanna Vickers?
John Dueso for the Controller's Office.
Mr. Philip Dukes? You want to read? Mr. James Levin?
Eddie Brown for James Levin.
Mr. Gerard Fitzgerald?
Present.
Mr. Addie Brown?
Present.
Mr. John Kelly?
Eric Fitzgerald for John Kelly.
Mr. Jack Kilty?
No,
John Farina for Jack Kelty.
Excuse me, we're doing the Firefighters
Oh,
VSF?
I'm sorry. I'm sorry. That's the firefighters. Yep.
Yes, so we have a quorum.
We'll have a quorum.
So we have called the session today to entertain a motion that was raised at the last meeting, which was the accepting the asset allocation for plan for the firefighters VSF to move towards a passive allocation in the fund. I believe that we all received information from NEPC regarding that option, and at this time we'd invite a motion to accept the recommendation of BAM and to move forward.
So moved.
Second.
Oh, I just realized I can't make the motion.
Okay, so I'll make the motion to accept the recommendation of BAM and NEPC.
Second.
Okay, so we'll just do a vote of that. All in favor?
Anyone opposed? Hearing none, motion carries.
Okay, so at this time, I'd like to make a motion to adjourn the Firefighters Variable Supplement Fund and enter into the public session of the Fire Officers Variable Supplement Fund. Lee, so that's my motion. Is there a second?
Second.
I think we need a second from the firefighters.
We need a
Second from Gerard.
Okay, thank you. So Lee, if you could call the roll for the fire
Any
officers.
opposed? Hearing none, motion carries. So firefighters VSF Fund
Thank you.
meeting is adjourned. Now, fire officers VSF Fund roll call. Mr. John Etler? Filled. Ms. Susanna Vickers?
John Dorset for the Controller's Office.
Mr. Antonio Rodriguez? Mr. John Farina?
John Farina, present.
Mr. Jack Kilty?
John Farina has Jack Kelty's proxy.
We have a quorum when we start the meeting.
Okay, so at this time, we've asked the board to consider a resolution to move the assets of the Fire Officers Variable Supplement Fund to a passive option that was discussed at the last meeting. Subsequent to that, additional information was provided by NEPC and by the Bureau of Asset Management to aid in the decision-making process. If there's any questions, we're happy to answer those at this time. If not, we would like to invite a motion to accept the recommendation from BAM.
I'd like to make a motion to accept the recommendations of BAM and NEPC for the Fire Officers Variable Supplement Fund.
Second.
No. No, I said no, I don't oppose, so. I don't oppose, I'm voting yes.
Motion carries.
Okay, thank you. So we have no other business before this board, so I'd like to make a motion to exit the public session of the Fire Officers Variable Supplement Fund
And adjourn.
and adjourn the meeting.
So moved.
Second.
Any opposed? Hearing none, motion carries.
Okay, so at this time, we are...
Lord? Wizard of Oz. Okay. During the executive session, the board discussed various investment matters and reviewed personnel decisions and made certain decisions about which candidates to hire. We now need a motion to adjourn.
Motion to adjourn?
Second.
Any objections?
Yeah.
Hearing no objections, we are adjourned. Thank you.
And note the item that we need to take a vote on.
Yes. During the executive session, the trustees heard 2 recommendations and presentations in the asset class of real estate. Action was taken, details to be made public at the appropriate time. Also during executive session, the trustees heard 2 recommendations and presentations in the asset class of hedge funds. Action was taken, details to be made public at the appropriate time. In addition, the trustees terminated contract negotiations with a manager in the asset class of hedge funds. Details to be made public at the appropriate time.
And also at this time, I'd like to ask for a formal vote to enter into the carbon disclosure project for a pro rata share of the cost of I believe it's $975. So I'm making that motion.
All in favor?
Aye. So with that, that concludes the business from the Controller's Office.
Make the motion to adjourn.
Second.
Okay.
And this is your last. Please report out of executive session.
Yes, the board took 2 actions in real estate, which will be disclosed at the point of contracting. The board agreed to pay their pro rata share of the expense for the carbon disclosure project fee. And the board approved the executive director search advertisement plan. That's it.
Okay. Very good. So that concludes our business for today. Is there a motion to adjourn? I move that we adjourn. Thank you. Is there a second?
Second.
Any discussion? All in favor of the motion to adjourn, please say aye. Aye. All opposed, please say nay. Any abstentions? Motion carries. We are adjourned. Thank you very much. Okay.
A technical slowdown. Some of the board members have had to leave, but this is the second time that TRS will be adjourning. And as a report out to the public, during the executive session, the teachers board voted in favor of 2 real estate recommendations, the contract of which will be released and made public at the appropriate time. They also voted to join the carbon disclosure project and to authorize an investment in a specific country for a emerging manager private equity fund. That's it. And so the board would normally take a motion to adjourn, which would be voted, everybody would vote in favor, and then the teachers' investment meeting for today is adjourned.